And one of the things that I believe modern portfolio theory has done is it has over-diversified portfolios. It has brought a lack of clarity in the understanding of the business's own. Yet I believe since the inception of time, no matter what kind of business it was, the greatest path to wealth creation and sustaining of wealth is investing in great businesses over time.
Welcome to It's All About Clarity, the go-to podcast for bringing clarity to your financial journey. Join Mark Pearson and the Nepsis team as they share insights to portfolio management, tax strategy, and more. Whether you're interested in investing, retiring, giving, saving, advising, or tax planning, here it's all about clarity.
Welcome to It's All About Clarity. I am the host, Mark Pearson. Today, nobody wanted to be my friend, so I decided to go solo on today's podcast. And today we're going to talk about a very important subject. This podcast will not be super long. I want to keep it simple. I want to give you clarity in some of the importance of investing and why it is important to have the ability to know what you own and why you own it. In the financial services industry, there is a phrase referred to as modern portfolio theory. MPT sometimes is what it's referred to. And modern portfolio theory is an investment process that many investors and, more importantly, financial advisors adhere to as they're managing portfolios. And the concept of modern portfolio theory has to do with a form of asset allocation. So what is modern portfolio theory? What does it mean? How does it work? Is it important? If it is important, why is it important? If it's not important, why is it not important? And I decided to do this podcast alone today because I believe that modern portfolio theory is a very important concept for investors to understand, and also understand that while some may think it's important, to me, I believe it's more important to know what you own and why you own it. What companies are you invested in? What industries are you invested in? What percentage of your portfolio is in certain industries? The concept of modern portfolio theory, in my opinion, is a process that was developed that enables financial advisors to be frank about it, to cookie cutter portfolios. What do I mean by cookie cutter? Financial advisors in general, these are going to be general statements I'm making, so don't hold me to this with everybody. But the reality is that the majority of financial advisors that I've run into that are out there are not portfolio managers. They are not money managers. They are asset allocators. What is the difference? A portfolio manager is someone who makes the decision in what businesses you want to invest in, what companies do you want to own in your portfolio, and how do these companies allocated together help you accomplish your financial goals. Asset allocating is more of a function of picking exchange-traded funds or mutual funds and or stocks and using what is referred to as style box investing. What is style box investing? Well, Morningstar, a very popular, well-known research organization, has created style boxes. And in the equity markets and in the fixed income markets, there are 9 boxes. We're going to talk more specifically about the equity style boxes today. There is what's referred to as large-size companies, mid-size companies, small companies. Pretty straightforward. In the financial services industry, there's what's referred to as quote-unquote value stocks and growth stocks, and a combination of value and growth, often referred to as a core portfolio. And so if you envision a style box of 9 boxes, you have large cap, mid cap, small cap value. You have large cap, mid cap, small cap growth, and then core in between. And many portfolios are allocated in a manner where mutual funds or exchange traded funds, also referred to as ETFs, are invested to develop this asset allocation in the style box. What ultimately ends up happening is you end up owning hundreds, if not thousands, of stocks in your portfolio. Now, some of you who have listened to my previous podcasts have often heard me say that the stock market is the greatest avenue ever created to bring buyers and sellers of companies together. The stock market was created to enable investors to take advantage of capitalism, to invest in great businesses over time. But over the years, as the mutual fund business and now the ETF business have grown, we have thousands of mutual funds and ETFs. We have inverse ETFs. We have industry-specific ETFs. We have gold ETFs, silver ETFs. What's an ETF? It's a bucket of investments wrapped into one fund, similar to a mutual fund. Now, what ends up happening is investors end up lacking clarity in understanding what they own in their portfolio. A question for our investors tuning in here to think about: what is the largest company in your portfolio as a percent of your overall portfolio? Do you know what the largest position is? Do you even know how many companies you own in your portfolio? This is one of the main reasons. And by the way, don't feel bad that you don't know. Most people don't know. This is my belief as to why most investors worry about volatility. And as Warren Buffett has said, volatility is your friend. Volatility is what creates the opportunity and the ability to invest more in great businesses over time. Now, I'm going to cover this in my next podcast when I talk about the power of a buy discipline and a sell discipline. But back here to modern portfolio theory, I believe that the main reason investors worry about corrections in the stock market is that they don't fundamentally know what businesses they own. They don't know why they own those businesses. They don't even know what percent of their portfolio those businesses are owned. And one of the things that I believe modern portfolio theory has done is it has over-diversified portfolios. It has brought a lack of clarity in the understanding of the business's own. Yet I believe since the inception of time, no matter what kind of business it was, the greatest path to wealth creation and sustaining of wealth is investing in great businesses over time. My belief is that modern portfolio theory clouds that ability. It clouds that opportunity. Now, I'm going to talk about another disadvantage of modern portfolio theory that we have come to realize from 2022 as it pertains to investing in bonds. But before we get to there, to get back to the style boxes, you have your large value, your mid cap value, and small cap value. You have your large, mid, growth. The problem with that idea is that you ultimately still end up having a lack of clarity, opaqueness to what's happening with your money. Now, let me make a very plain, common sense statement. You work or worked very hard for your money. Does it really make sense to invest your money in something that you don't even know what you're investing in? No, that does not make sense. It lacks common sense. Do you ever know a business owner who doesn't know what they're investing in? Do you ever meet a business owner when they make an investment in their business or businesses, they don't fundamentally understand why they're investing in those businesses? Of course not. They know where their revenue comes from. They know where their profits come from. And ultimately, many people watching this podcast don't have time to manage their own money. They don't have time to do the research. That's why they hire a firm like Nepsis to manage their portfolio for them. But when you get to a point when you want to know what you own, you want to know why you own a specific business and how it actually impacts your portfolio, and more importantly, your ability to accomplish your financial goals, you have the ability to talk to a Nepsis financial advisor and get greater clarity in what exactly is happening with your money and why it's happening. My head of research, Chuck Etzweiler, and I have talked about this in the past. The average correction on an annual basis from top of the market to the bottom of the market is a 14% correction. We always tell our clients, always be prepared for a 20 to 30% pullback. Why? Because when you get to that point, you have created yourself one of the greatest opportunities to continue to invest in the specific businesses you want to own. Reality is, depending on what study you read, a portfolio of 20 to 40 companies is an aptly diversified portfolio. That's it. So why do people own hundreds, if not thousands? Because financial advisors teach their clients to manage portfolios through volatility. There are a lot of financial advisors out there who pride themselves on the idea that we try to minimize your volatility. We don't. We want volatility because volatility is short-term and it creates the opportunity to take advantage of buying more businesses on sale. So a portfolio with 20 to 40 companies in it is an aptly diversified portfolio. Here's another statistic that's important to know. Again, it depends on the study you read, but studies show that a portfolio with dividends is extremely important. Historically, dividends have provided anywhere from 40 to 60% of a total portfolio's return on an annual basis. Dividends are a critical component to the asset allocation. Now, earlier in the podcast, I talked about the idea of modern portfolio theory and style boxes and the idea of investing in value and investing in growth, and the idea that asset allocation is very important. Now, what's the difference between diversification and asset allocation? Diversification is a portfolio with hundreds, if not thousands, of stocks in it. You own hundreds and thousands of stocks that basically may be in the same industry or the same asset class. What is asset allocation? Asset allocation is the idea of owning specific investments in specific asset classes. I'm not talking about just equities in the stock market. I'm talking about specific industries. Maybe it's energy. Maybe it's healthcare. Maybe it's utilities. Maybe it's technology, and so on and so on and so on. And inherently, companies, stocks in particular, have certain characteristics based on the industry they're in, based on their valuation metrics, based on other factors that will give you indications of their relative volatility compared to the overall stock market. Remember, most portfolios are invested in a manner that I refer to as cookie cutter, over diversified. Why do you need to own 40 technology stocks? Why do you need to own 30 utility stocks? Because as Warren Buffett says, Diversification is nothing more than an excuse for doing something when you don't know what you're doing. At the end of the day, portfolios get diversified too much because they don't know what they own, why they own it. They don't have a specific buy discipline and sell discipline, and it's the tail wagging the dog. What do I mean by the tail wagging the dog? Investors are more concerned about volatility in their portfolio than they are concerned about what quality businesses they have in their portfolio and how they're going to accomplish their investment goals long term. So, asset allocation versus portfolio diversification. Knowing what you own and why you own it versus not knowing what you own and why you own it. Let me talk about one last point that caught people off guard in 2022. The idea with modern portfolio theory is to cookie cutter the portfolio between your equities and also bonds. As many of you have heard me say in previous podcasts, we really have not owned bonds for our clients since 2014. Why? Because the industry tells you you should own bonds to mitigate volatility. We say, why mitigate volatility? We like volatility. Now, volatility is a relative statement. Obviously, depending on your investment objectives, we're going to manage the volatility in your portfolio. But it is still going to allow us, create for us, the opportunity to take advantage of owning very specific investments in your portfolio during those volatile periods. Now, I understand some people aren't going to agree with what I'm saying. That's okay. Chances are they're not portfolio managers, they're financial advisors. This is one of the things that makes Nepsis different in how and why we manage our clients' portfolios internally here at Nepsis. I'm not even getting into the other ancillary benefits of owning great businesses in a portfolio and the asset allocation of that. Those are for conversations for another day. But let's talk about bonds for a second and how it has made modern portfolio theory a bit of a flawed theory. In 2022, as many of you know, the average bond fund was down over 20%. Well, wait a minute. I thought bonds were designed to mitigate volatility. At the end of the day, while the industry focuses on volatility, we focus on quality of investments. There's a big difference. Quality of investments with bonds are not there. That's the reality. As interest rates are at 1%, 2%, 3%, inflation's at 1%, 2%, 3%. How much money are you making on your bonds? Really nothing. If your portfolio is going up with the cost of living, with inflation, net, you're not coming out ahead. That's the bottom line in fact. And when you have an environment where bonds are going up in interest rate like they did in 2022 and 2023 and here in 2024, what happens? You lose value in your bonds. Oh, and as you lose value in your bonds, what also do you lose? Purchasing power. The value of your bonds go down, inflation is going up, which is exactly what happened. And many people were stuck with bonds in their portfolio down 20% in 2022 as interest rates went up. Why have we been out of bonds since 2014? Because the risk-adjusted return, the risk relative to the return that I'm going to achieve in owning bonds was not there. Quite frankly, even today, as the 10-year sits at 4.6 and inflation is sitting at 3 to 4%, really, you're not gaining much purchasing power. And as history has now dictated in the last couple of years, that volatility is not helping the course of modern portfolio theory either. At the end of the day, successful investing and accomplishing your investment goals is a function of having the ability to know what you own, why you own it, the amount you own, and how it impacts you and impacts your long-term financial planning goals. And that is a baseline for what we call investing with clarity. So I want to thank you for tuning in today and watching. In the next podcast, I'm going to be discussing the importance of a buy discipline and a sell discipline, and how that is more important than modern portfolio theory. Thanks for tuning in today, and remember, at Nepsis, it is all about clarity. Thanks for joining me.